As gospel to the founding fathers, Adam Smith discerned the secret to prosperity. He said, quote, "Little else is requisite to carry a state to the highest degree of opulence from the lowest of barbarism, but peace, easy taxes, and a tolerable administration of justice." Says all the rest can be brought about by the natural course of things. So opulence is the antidote to strife. The British sage Samuel Johnson is one of my favorites, observed. He said, "Men are seldom more innocently employed when they are honestly making money." He said, honestly. Yet the twin scourges of war and penury have beset mankind since time immemorial. So what explains this paradox? The truth? My favorite movie. The truth. The truth. You can't handle the truth. We can't handle the truth. Species narcissism blinds us to the innate depravity of man. Pat, you know how to work the original sin into this, didn't you? Our heart self is overrun by the drive for power, the drive for money, the drive for sex, the drive for fame, and the thirst for certainty. Power ellipses all. Henry Kissinger eloquently said this, expressed this sentiment by saying, "Power is the ultimate aphrodisiac." The hunger for power gives birth to delusions of a chosen people. Exceptionalism to justify blood-stained conquest for global domination by force of arms. Thus, empires are born. Empires are doomed to financial collapse and self-ruination. Example, the $300 million that we spend every day in Afghanistan for 20 years have now suddenly been redirected to the Ukraine. Our impending bankruptcy traces back to the voracious financial requirements of our empire. A single aircraft program, Lockheed Martin's F-35 Joint Strike Fighter, costs $1.7 trillion. That's right, 1.7 trillion. So let's bring back the good old days of $600 toilet seat covers. Empires become highly skilled at hiding their cost. Raising taxes is always avoided. The tried and true method is to inflate the currency and borrow. Tonight, Bob Wiedemer is going to explain to us how the American empire will end like the 66 other empires that went before us in the last 3,000 years. Bob is a hedge fund manager and the best-selling author of Aftershock. If you haven't read Aftershock, you gotta read Aftershock. And now this new book, Fake Money, The Real Danger. So Bob, come tell us about the real danger of fake money. And this is going to be Bob's. You've probably seen Bob on CNN and Fox, and he's on TV a lot. But I can guarantee you that they won't ask him to make the connection between empire and all this spending and borrowing.
Glass of wine, water more than wine. So after John makes such a wonderful introduction, I feel like I'm about to, I need to present you War and Peace or something. But no, it's just Fake Money, Real Danger. And we're going to talk a little bit about, what this all means for empire. But also just, it's a fascinating, I think everybody would agree we're in an amazing economic time, unquestionably. I think we all know that we've had just unbelievable interventions by the US government that we've never seen before in terms of borrowing, money printing, etc. But we're gonna kick off on sort of a quick note. Actually, let me make sure I know how to work this. Did it work? Oh my God, great. I can't believe I don't really need a microphone here. Can everybody hear me even if I'm not next to this microphone?
Use the microphone.
All right, use the microphone. All right.
The online people
Okay.
appreciate the microphone.
Oh, geez, all right. So in any event, yeah, John mentioned I did do another book earlier, actually a series of books on Aftershock. I also did one called America's Bubble Economy. That was 2006, and frankly, one of my favorite books. Kind of talked about what ultimately happened in the financial crisis. But let's talk about sort of where do we stand today? Are we in an economic investment bubble? I mean, there's a lot of people who say, oh, gee, of course, we went through a big one in 2008, we had the dot-com bubble, but are we in one today? And people are kind of hard-pressed to say, well, you know, no, there's no dot-com problem, right? There's no, housing might be a little high, but don't go overboard. So, you know, let's talk about a broader, I like to look at a broader view of the economy. How much of our economic growth comes from government borrowing? I just mentioned how important that was, but I'm gonna, you know, we're not moving on until we get a few hands here. Is it like 10%? You know, a quarter of our growth is due to government borrowing.
100%.
Yeah. What? 4%, you know. Anybody think higher than 10? I mean, John thinks it's all gonna, you know, empires.
25.
25, all right. And that's kind of honestly what I would have thought before I really did a little bit of research. And this doesn't take a lot of research. It basically means going to Fred. Does everybody know what Fred is? It's essentially, yes. Yeah, the St. Louis, the Federal Reserve Bank of St. Louis does a wonderful job of putting together statistics, and its database is called Fred. So if you want to find anything, go to Fred GDP, Fred number of churches built. I mean, they really go into detail. You know, Fred number of warehouses built and all that kind of stuff. So here's the answer. I hate being stuck to a microphone. God. Our answer is, yeah, all. Oh, I can take it out. Okay, good point. Yeah, right. Oh, all right. Now, you know, I wish I were an Oscar Mayer. You know, I do all sorts of singing. Yeah, all. And that's rather stunning. I mean, think about that. I mean, I could do the whole presentation on this alone. All of our growth since the financial crisis has come from government borrowing. And those of you who kind of follow statistics can think of it this way: is if we had 1% growth, and we usually are, you know, we get 2 generally. 3 is hard to catch, but you know, 2% growth. But if you get 1% growth, that's about 200 billion. If you get 2% growth, it's about 400 billion. Our economy is around 20 trillion, give or take, the last 10 years. And how much do we usually borrow each year? Well, it's been a few years we've borrowed less than 400 billion, right? In fact, you're looking at a couple of years during Obama, we did actually borrow, you know, a little less than we grew. But for the most part, and you can see, oh my God, right, during the COVID years, this is it. I mean, that's stunning. I mean, let that sink in, guys and gals, that we aren't growing at all if it weren't for government borrowing, okay? To me, that's the definition of a bubble, if there ever was a bubble. That's like a company that says, oh yeah, we're going great. Why? Well, because I borrow, you know, 20 million a month from Wells Fargo Bank. Huh? No. So this is a real issue, is we're just not growing, except for government borrowing. I mean, you know, if we cut the deficit, everybody says, oh, geez, how much is the deficit hurting us? How much is government debt hurting? It's not hurting us at all. If we cut it, we'd be in a massive recession. You know, it'd be like the equivalent of eliminating the entire military budget and more. Military budget, 800 billion, and you throw in the vets and some other things, maybe it's $1 trillion. You wouldn't even begin to get rid of our, well, maybe this year we're going to do $1 trillion deficit. I mean, last year we're closer to 2 trillion, okay? I mean, I don't care about the magnitude of the numbers. What I'm really worried about here is, you know, the percentage of our growth that's due to us borrowing money. And we're hooked, okay? And of course, this has all led to a debt that's just way too big to pay off or even think about it. In fact, I don't know if you remember, there was a time where there were like filibusters in the Senate when we had to raise our debt limit to $1 trillion. There was another one when we raised it to $3 trillion. Now nobody gives a damn, all right? I mean, it's 30 trillion. And in a sense, it's for good reason, because at this point, how in the world are you going to cut this thing? 30 trillion in debt, okay? I mean, if we cut spending by $1.5 trillion tomorrow, it would take us 60 years to pay off this debt. All right, 60 years. And why so long? Well, you know, you get a lot of figures that economists come up with, and I think they're all to kind of avoid the real issue. You ever heard of the debt to GDP ratio, right? You know, debt to GDP is like 1 to 1 or 1.5 to 1, and that doesn't sound too bad, does it? But that's kind of irrelevant. Debt to GDP, who cares? Does our GDP pay our debt? No, right? Taxes pay our debt. It's just like Amazon. What's debt to GDP for Amazon? It doesn't matter. It's what debt to Amazon's revenues and income is. And so let me just ask real quick. I mean, and a few people I've talked to before have talked about this. What do you think our debt our debt to revenue ratio is in this country? Anybody, you know? I mean, there's some business people out here. Our, you know, United States government, that's who pays our government debt. So government debt to government revenues. Any guess? Yeah, exactly. Let's say you're a businessman, you know, and you own or businesswoman, and you own the Tabard Inn, and you've got you borrow $10 million to buy the place, and your revenues are debt to, you know, that seems 40%. Seems reasonable, right? Right. Seems reasonable. It's closer to about 900%. Bingo, right. Take the Tabard Inn and go to a banker and say, I want to borrow $10 million on this place. And, well, what's your revenues? Well, geez, they're about 700,000. Well, what are your earnings? Well, they're like zero. And you want me to lend you $10 million? I mean, we are so far off of any sort of reality here that it's ridiculous. And as I said, when I ask these, you know, I presented to like groups from like SIFMA at Wharton and others, and I asked this question, and believe me, all these people they're not all from Wharton, but you know, they're pretty good. Actually, I did speak to the Wharton alumni group here in DC. They don't know the answer to that question because nobody talks about it. Because it does sound awful, just what you said. It's not 40%, it's about 900%, right? We got about 9 times the amount of debt we have revenues. And by the way, if nobody noticed, we're not making a profit either at the government. So am I into this? Yeah. So I've just come up with 2 big numbers that I think are just stunning. All of our growth is coming from borrowing, and our borrowing is our debt is now about 9 times our revenues. Okay. You know what's funny? Google. And if you want to Google it right now on your cell phones, this is one time I don't really care. You can look at your cell phone and Google, debt to revenue for the government, or Google, what percentage of our growth comes from debt. You won't find these numbers anywhere, okay? They're not hard to do. Again, go to Fred, the Federal Reserve. This is, not hard. Do a little math, and you know what? You'll have these numbers. But you won't see them anywhere. I mean, you'll see economists talk about, well, what's the productive potential of our economy? What's going on with our low taxes or our savings rate? All problems, by the way. I mean, we have a very low tax rate. We have a very low savings rate. But, that kind of sounds like something you could talk about. Whereas this, it's not something you can talk about. It's so awful that you kind of want to go, next slide, right? And so what's really happening is 2 things. One, life is good in a bubble. We don't want to think that what we've got is due to a bubble, right? We want to think that we've earned all our money, that, I invested in the right stocks. IBM, I got it right the time. Tesla, oh my God, that was great. I'm so smart, so is my, investment advisor. Or, I really know real estate. Nobody wants to think that all this comes, from borrowing massively by our government. Oh, by the way, in fact, Celine, John, you want to pass out maybe at some point, maybe later. We have handouts. I have handouts of this whole presentation I printed. So I don't know. Does anybody want them now, or is that going to be disruptive? Yeah, why don't we just pass them out, okay? Because some of these are a little hard to read. I mean, you don't speak from a TV screen. But I love cartoons because this is, as they say, it's kind of economics. It's a little boring, and I'm not particularly fun when it comes to investments. But we sold our 2-bedroom in the Village at a great price and bought the Virgin Islands. And anybody who knows New York real estate, they know this is not too far from the truth, right? It's good. Life is good in a bubble.
but delusion is critical. And that's a little bit meaner and tougher, right? That's why, these are cartoons. You don't see cartoons about delusions critical. We're sort of deluding ourselves pretty heavily here. When economists, and I don't mean Democratic economists, I don't mean Republican, I don't even mean Wall Street economists. All economists, for the most part, don't talk about this. They really don't. In fact, I actually did Google, by the way, debt to revenues for the government, and I found one guy in Chicago as a CPA, accountant, who said, nobody does this math, but, I do this for companies, and guess what? It doesn't look good, That was it, some goofy CPA from Chicago. Not Harvard, not Hopkins, not any of the great economics, colleges, but a guy from Chicago. And this is terribly important. We're being delusional. We're trying to delude ourselves that this is not a bubble, that we really don't have any problems. We do. And I think that one figure says that's the problem. We cannot create real economic growth without the government borrowing. And anybody, I've made that pretty clear, right? My wife sometimes says, Bob, you've said it about 10 times. Well, and I know. I just want to make sure we recognize that is a big deal. We can't create any growth. So, okay, so we're in a massive bubble. Okay, who cares, right? All is good. We just keep the bubble going. Everything's fine, right? Well, maybe it'll pop. There's a lot of people who say, John will tell you that something can't go on forever. Well, it doesn't, right? It will pop. And so really the timing is down to one simple thing. It's not really black swans or any issue. Timing depends entirely on when printed money creates quick double-digit inflation. We printed a lot of money over the last 10 years, and we haven't gotten much inflation out of it. We have really printed a lot of money. I'll show you in a second. And we've been very lucky. That's really been the key to our success. They always talk about, how to be a successful businessman. Well, the key to success in economy is to be able to print money without getting inflation. Man, if Argentina could do that, if Turkey could do that, they'd be just booming, right? It just doesn't really work that way. But for us, it does. And that's why I'm saying black swans aren't important. There's always a lot of talk about what's the next financial crisis going to come from. And I say at this point, nowhere. Because private money and private markets are so small compared to what the government can do. I do investment banking work, and I travel to New York a lot. And I used to joke with my friends up there, and they'd say, if Goldman, I tell them, if Goldman Sachs lost $15 billion this year, what would happen? Oh, geez, Goldman Sachs lost $15 billion. Oh, it might go under. They're very careful about the risk management. They give me all the pitch and all that. Well, what if they lost 25? That's it. Gone. It's Goldman Sachs. This is where all the billionaires are made. I tell them, what? Back down in DC where I'm from, 15 billion? That's a rounding error. Come on, it is. So we got a $30 trillion debt, and we have to add 15 billion to it. 30 trillion, 15. We're not going to have any more black swans. Okay, the government has the money to bail out practically anything out there, and it will. And in a sense, for a good reason, is that there will be a financial crisis if they don't. If you really let something go and create another financial crisis, that's a problem. And the fact that they bailed us out so quickly at COVID should tell you they're very sensitive. And they got very sensitive after the financial crisis. They will bail us out. Black swans are just not that important. Now, what's the other issue when you print a lot of money, right? Or borrow a lot of money, excuse me, like the government's done. It used to be something we called a crowding out effect. Boy, this is an old 1970s, 1980s economic term. Crowding out effect. It's when the government borrows so much money that private industry has to compete with the government, and it can't. And prices just go up, interest rates go up. So that's the real problem of borrowing money. And to keep that from happening, the Federal Reserve has increased the amount of money it has printed by over 1,000% since the financial crisis. Why can we borrow all this money and not cause any big problems? That's the reason. We printed money, and a lot. Let's look at a chart here, okay? This should tell you, okay, we were, this is where we were about 800 billion in 2008. And by the way, that's kind of where we were for a long time, okay? We increased our money supply, but not much. But the Fed, of course, in 2008 had to quickly print money to deal with the crisis, right? Which people, generally, I find a lot of economists say that was a great move. I'm not so sure. And then we kept printing more and more and more and more. Oh, COVID, up. Actually, we're now up to about 8.5 trillion, a little more than that, actually, almost 9 trillion. That's a lot of money, right? I mean, that's a 1,000% increase practically in your money supply. All this money was, amount of bonds the Fed has bought with printed money. That's how many bonds they own right now. And by the way, of course, they're now, as we all know, trying to turn it back down, but it's, doesn't really show up too much. They're trying to sell some of their bonds, and they got a lot of bonds to sell. Right now, our what they call our balance sheet, which is basically, again, the amount of money we printed to buy bonds to keep interest rates low, is very high. And so, at 9 trillion, it's going to be hard to bring it down. It's kind of like the debt, it's really high. Let's also say that low interest rates have not only made it really easy for the government to borrow money, but what else have they done? Low interest rates started coming in, kind of in this area, right? 2000, 2008 especially. Let's see, this is 1928. That's the Dow. Okay, doing okay. Now we're starting to pick up, 1950s, 60s. It wasn't doing so well during the Depression and World War II, but man, it's starting to pick up, not bad, okay? And then you notice we oh my God. Greenspan was in there a little, yeah, a little bit. Yep, and yeah, you got the Greenspan errors kind of in here. But look at this. Right. Low interest rates are just incredibly good for stock prices, but not just stocks, but real estate, bonds, everything. In fact, it's just a mathematical, Finance 101, I know not everybody took Finance 101, thank God, but Finance 101 tells you that as your, what's called the risk-free rate, your rate of interest rates goes down, the value of any money you're getting in the future, so let's say the Tabard Inn is gonna make, $1 million a year for the next 10 years, I'm sure, maybe probably not, but let's say it makes $1 million a year. That's worth a lot more now if interest rates are low. The interest rates are high, it's worth a lot less. So what's happened is as the interest rates come down, your home, your business, your warehouse, your restaurant, your everything has gone up in value on real estate. Bonds have done phenomenally well during that period. You bought a bond at 10%, we're now at 2% interest. Your bond's fabulously more valuable than it used to be. And same with stocks. So there's been, a lot, this is where there are other bubbles, but, that's important to recognize, is that low interest rates kick all these assets up. And, we could also postpone the pop. I say it's going to pop at some point when you start getting quick, immediate inflation, which we haven't gotten. Anything like what we've done in printing. In fact, in my Aftershock book, there's a wonderful quote from the Fed saying that essentially for every 100% increase you do in your money supply, you'll get a relatively similar amount of inflation. We've done 1,000% increase in our money supply. We haven't had 1,000% inflation. So we've been able to get out of that. I think we're starting to where we're going to get some inflation with that money printing. But keep in mind, some of the inflation today is not really inflation. It's just supply and demand. We've got tighter supply of oil, natural gas, whatever, and prices go up. That's as it should be. It's not really inflation. We're all calling it wrong, including some very good economists. Paul Krugman and others are calling this, supply and demand inflation. It's not. But basically, if we want, we can postpone the pop when we get quick inflation simply by printing more money and keeping interest rates low. Because again, the key to keeping everything going is keeping interest rates low, not high. Yeah, we want to keep rates low to keep assets high priced, and that also helps the economy grow. Okay, and it makes it easier for the government to borrow massively, which is the source of all our growth. And so what you're going to do is you just basically keep printing. Not right now. I know the Fed's not, and the Fed is actually slowing down its printing. In fact, in August, they sold off 50 billion. Oh my God, 50 billion in bonds. They promised to start doing that in June. They didn't, and they didn't do it in July either, probably because the market was weak in June, and now they feel more comfortable doing it. But they're also promised to move it up to 90 billion, sell off 90 billion in bonds in September. We'll see if they do. I think at some point in the next 6-12 months, they're going to stop, and they got to keep rates low. And this is what we're going to do. Keep printing more money, keep interest rates low, and of course that'll create inflation. And again, people think the Fed's got our back, but what really happens is, I love this cartoon, is now we just have to sit back and wait for the Fed to bail us out. The two kids bashing the piggy bank, right? Which is kind of the moral hazard everybody's worried about, is that the Fed is making it so much easier to take big risk in business and not worry about it because you kind of get bailed out. But the bigger issue is that the Fed will sort of keep us all these problems I talk about, somehow the Fed will figure it all out. And, they're smart guys, and they are. And there's also bipartisanship on the Fed. I mean, lots of bipartisanship. So, there's Republicans, Democrats, they all do about the same thing, which is print more money. Because they kind of have to. And I think that's what you're going to continue to get is, more money. And this is a great chart. People say, well, the Fed will take control of it now, right? This is, total, again, this is how much money the Fed printed during, from 2002 or something to 2008. Not much, economy was good. Again, we had the financial crisis. We should have brought this money back. In fact, I actually had a lunch right around here with the guy who actually runs the Fed open market operations. And for those of us who don't know, when the Fed wants to raise rates or lower rates, they do it simply by buying or selling bonds. And so if they want to lower rates, they buy a lot of bonds. And they can buy as many as they want. There's no limit. They can literally run out and buy $10 trillion tomorrow. We don't have any limit. So, I was talking to the guy who basically had his finger on the printing press there. And he said, God, Bob, what we really got to worry about is look at what we've done to her. How much money we printed to save us in the financial crisis. And when you compare it to the years before, it is a lot, right? And that's amazing. And I said, I don't think we're going to have to worry about bringing this back down. I think what we got to worry about is it's going to keep going up. Oh, no, it's not going to go up. What really happened? Well, now we're here, and everybody's telling me that now, Bob, now's the time we're going to get this under control. And, some of John's friends have said, don't worry, Bob, the Fed will get it under control. What in this chart gives you that kind of confidence that the Fed will get it under control? They won't, and I'd say they can't. If they try to do this, your asset prices will plunge. Your home value, your stock value, your bond values. And we're all invested in bonds, by the way. I mean, my life insurance is Northwestern Mutual Life, and I look at their little description of what's invested, and it's 80% government bonds. We have a big incentive to keep printing money to keep this thing going. So what's the solution? I have a lot of doom and gloom here and all this. Solution's simple. Don't do it in the first place, right? I mean, that's obvious. In other words, don't do something stupid. Maybe a terrible example, but it's kind of like, well, what do you do after Stalingrad if you're Germany? Don't invade Russia in the first place, okay? Oh no, Bob, we'll beat them at Kursk. Yeah, we'll beat them at Kursk. We'll get them to death. We'll get them in Belarusia. Come on, guys. You've blown it, all right? So what's plan B? Keep pumping up the bubble until it bursts, and that will solve the problem. And that's what we're going to do. I'm not telling you this because I'm some like doom and gloom or anything. I'm not. I'm very optimistic for the future. I just know how we learn. Kind of like the Germans learn. Don't invade Russia. Why? Well, because Russia might end up going to Berlin. No, not a chance at all. Yes, again, you're deluding yourself. Russia has a lot of productive capability. No, they're not. They don't all hate Stalin. They actually fight harder for Stalin than they did for the Tsar. Blah, blah, blah. Well, it's impossible. Well, okay, as we know how that turned out, right? I mean, the Russians basically, by the time we entered the war, the Russians were almost on the German border. They practically destroyed the Wehrmacht, the Air Force and Panzer divisions and everything. And, thank God for it. I mean, I still bless Russia to this day that my Uncle Joe, who was in the Third Army, didn't have to face all of those Panzer divisions and all of the German Luftwaffe that the Russians, took care of themselves. And thank God they did. But back to this, so it didn't work for them. And I'm saying it's not going to work for us, is that ultimately we're going to pump this thing up until it bursts. Because it's so much easier. Because it's so inviting, isn't it? What if you had a credit card that you never really had to pay back, right? I mean, what if the option is letting your stock market go to hell, but I could just print money instead? Oh, I think I'll print money instead. I mean, it's very obvious. Now, why am I long-term very, very optimistic? Because I think we will reform. I think the idea that we don't reform is silly. I think, as Germany shows, Germany is no longer, a Kaiser. It's no longer a Hitler. It's actually a pretty modern democracy, And by the way, Japan is too. So to think that just because you learn the hard way that everything's going to go to hell long-term, no. I mean, people say, Putin's a real problem, and, I understand some of the issues, but let me tell you, 100 years ago, Russia was under the Tsar. Bigger problems, People talk about Turkey today. They have Erdogan, who is a fairly strict authoritarian, president. He is elected. I mean, they used to be, Ottoman Empire. They were kings, and, the king was actually the Pope, equivalent in the Muslim religion. So a lot of good changes can happen, even if you learn the hard way. And this will be one. We will reform. At the end, we're not going to go back to the gold standard, no, which, I mean, all the sort of conservative people like, and I understand. And the gold standard has good issues because it immediately, just like what would have happened in 1972 if we didn't go off the gold standard, we would have run out of gold. We were losing about 1,000 tons a year, and we only had about 14 million, I think, to start with, 14,000, excuse me, and we let it go down to about 8,000, and that was it. We still have those 8,000 tons of gold, theoretically, who knows. But, we would have run out. And so we changed, and that, of course, allowed a lot of what's here to happen. We were able to get a lot more money in, but we can change. We can't ultimately restrict how much money we can print, how much money we can borrow, and we will. But, yeah, you're right. It's going to have to get really tough, okay? In other words, we're not going to do this just because Bob says it, or Dave Stockman says it, or other people say it. We're going to have to hit it. The wall. So a lot of reform. Also, we got to remember, printing and borrowing was actually very critical, especially a few hundred years ago, to financing wars. I mean, this is really where it came from. Keynes, when John Maynard Keynes said we can do a little more printing or borrowing, he was just adapting from what kings had done for a long time to finance wars and say we can also do this for domestic programs too. We could borrow a little or whatever and pump things up. But ultimately, the power to print and borrow is less and less necessary to fight wars. And of course, I'm one of the few who thinks we're going to be fighting fewer and fewer wars, Ukraine aside. And I would say if you look at the last 50 years, you'll find I'm right. In other words, our war costs are down phenomenally from 50, 60, 70, 80 years ago. And just take a look at World War II and others, and we're way down from that. No longer necessary to print money and to borrow. So what else are we going to have to do other than reform how we print and borrow? Well, cut spending, especially in the military. One of the reasons we have such a big debt right now is that we're in a period where people love the military and they love military spending, but they don't want to pay for it. It's kind of like Vietnam. What Johnson ran into is people loved the Vietnam War in a sense, but they didn't really want to pay for it. So we printed. Afghanistan, we go into that and we give everybody a tax cut. I was talking to one of John's friends who I said, this isn't always true. Back in World War II, we actually paid our way with World War II, right? I mean, we raised taxes, 90% was right? And a lot of bonds and so forth. We did borrow a lot. Anybody remember how long it took to get rid of that deficit? Because that was our biggest deficit outside today. We ran some big deficits in World War II. We kind of had to, right? It's a real threat.
World War II debt, we paid off by about 1960.
And more importantly, when did we reduce the deficit to zero? When did we stop borrowing more? No, actually, surprisingly, by 1948, we ran a surplus. 48, take a look at it. It was a surplus. What happened? Well, I can tell you what happened. My father got fired, so did my uncle. They had done a lot for this country, it's no fun being in the Third Army, maybe it has some upsides, but not much. And they fired everybody. And my grandfather was a government contractor, military contractor. They fired him too for his good service in the war. They fired everybody. That cut the deficit enormously. Tens of millions of Americans who had fought or served for the war were all, kicked off and said, go find it on your own. Go back to the old great movie, it's not It's a Wonderful Life. It's the best years of our lives. It talks about three people returning home and what they returned home to from World War II. And it was tough. Guys, there weren't a lot of jobs. It was hard. But back then it was real money. It wasn't fake money. We kind of knew it. And this, by the way, a Democratic administration, which theoretically is, a lot more interested in printing money and spending money on social programs. They didn't. We brought it under control very quickly. Now, we had accumulated a debt, and yes, that took a long time to pay off, but we stopped adding to it almost immediately. And that's important. We did that. Whereas, we keep adding to it all the time. So what you've got is a lot of money went to the military, and I would say that's actually the source of of a lot of your debt you have today. When did it really start? Well, it was when we stopped doing what was called the guns and butter trade-off. Remember that was a 60s term, is we either put money in social spending or we put money in the military. And we kind of stopped it in Vietnam a little bit. That's why Johnson knew very, I think, correctly that politically you don't want to raise taxes to pay for the Vietnam War, just print a little. But with Reagan, you got it solid. Dave Stockman hit it right on the bat. Reagan wanted to raise military spending. Okay, fine, great. All right, Ron, where do we cut? Well, we'll cut with Social Security, I guess. But no, all my voters like Social Security, so we didn't cut Social Security. We stopped making a guns butter trade-off in the 80s. We wanted a lot of guns. We wanted sort of, for whatever reason, we wanted a lot more military, and we didn't want to take the cuts. So we ran up a big deficit. And really, that's where it kicked off. And once you kick off a big deficit, it's hard to stop. And I would say this is very important because, just as Paul said, your friend, is that, gee, there was a real threat in World War II. Yeah. Whereas there really wasn't as much of a threat in 1981 or 1982. We just wanted to build a big military. We didn't have the Japanese army or the Japanese Navy, bombing our bases in Pearl Harbor. We didn't have the German army declaring war on us and obviously attacking some of our close allies like Britain and France. But we still did it, but that's part of the problem is we did all this spending without really wanting to pay for it, so we borrowed. That's something that will change in the future. You'll cut spending, especially the military, we'll raise taxes, and most importantly, and something I would love to spend an entire salon on, is productivity increasing. This is terribly important. I mean, our productivity is not increasing. Oh, we got computers and all this. Well, look at it this way. Who's some of the biggest users of computers in the country? Medical, education, government. Biggest consumers of computers. Do you think productivity in those three areas has really massively increased in the last 10, 20 years? Not so much. In other words, you need to, real productivity improvements take time and they're tough. And I'd love to talk about it because that's really the bottom line issue. And all my writing right now that I'm doing is on productivity improvements. It's on how technology evolves because of changes in, improvements in our knowledge of science in the world. We improve our technology, and that technology affects our economy, and that affects our politics. And that's a very, very upsetting thing to talk about. So I'm writing those books more for me and for release later when I think people are interested in productivity growth. They're not now. But that's really what we're going to have to focus on. That's the big hit from all of this, is when we can't get growth from borrowing from the government or just from assets flying high, which produce a lot of jobs and a lot of income, we're going to have to increase productivity. And we've done it before, and we'll do it again. So again, very optimistic, but it is a lot tougher to get growth out of productivity than from bubbles. You will find no Elon Musk in an era of productivity growth. You might find a Ford, but he makes his money off profits. He doesn't make his money off valuations of Ford Motor. Elon Musk is not making his money off profits. It's all valuation of a bubble. But I would say nothing better than the bubble for making money. So, let's bring it down to a personal level. You can take advantage of it while you can. And I think this bubble will keep going on for a while. Again, until we push the print button and we get immediate double-digit inflation, I think we're good. And that means for real estate, although I think you'll find stocks will be the best. I know it's tough now, but I think stocks will do well because real estate, at least on the housing side, is going to run into a problem. People don't have the money to pay these prices. I mean, we really are hitting that already. Things like office buildings and stuff are, not doing so well. Bonds, I think, have kind of, not going to do well because I don't think we're going to see interest rates going down a ton. And that's really what's made the bond market great. So I'd ride that stock bubble, but keep in mind, people like to ride a stock bubble by picking the right stocks and, picking the right timing, and oh my God, is commodities it, is hydrogen power it? Well, and you'll read in my book, if you want, chapter 5, smart managers, especially super smart billionaire hedge fund managers like Bill Ackman, Ray Dalio, who, by the way, are very good, or Dave Einhorn, who I've met and had quite a few discussions with, great stock pickers. But since the bubble really kicked off in the financial crisis, none of them have been able to beat the S&P 500. I mean, you all could have, instead of paying these guys billion-dollar fees, I know you're not paying them, but somebody is. You could have beat the pants off of them by just buying SPY or any index fund, that just follows the stock market. My numbers are in the book, but I think it was Bill Ackman or at least Dalio was only up about 150 or 60%. That's why nobody criticized. They're still making money with them. But the S&P was up 250 since the financial crisis, almost 260. So, you should always be trying to beat the S&P 500, but you have to get out before, again, we print the, push the print button and it creates inflation. Anyway, that's just a small advertisement. I won't go into that, but yeah, that's obviously what we're in the business of doing, is helping people beat the stock market. So with that, lots of questions. Hopefully, do I have any time left, John? All right, try to keep that to modest time.
So what do we have here? Okay, Warren Coates.
John, we have another microphone over here.
Thank you very much. I'm all with you on productivity and the importance of that. But I'm totally against your proposition that government borrowing contributes to growth. It contributes zero. Anything the government borrows, it's taking from people who would have invested it in something else. So the question really is, what is the government doing with the money it borrowed? Is it investing it in ways that contribute to productivity, for example? Or is it writing off college debts, or what's it doing? It's what government spending does that may or may not contribute to growth. Borrowing contributes nothing.
Correct and incorrect. In other words, if I go out and I'm the government, I borrow $1 trillion, and I go out and I spend it. I don't care what I spend on it. I spend it in the military. I give it out in Social Security payments. I do. That's growth. Why? Because I don't have to pay that back. The government never pays that money back. All right? It's pure stimulus. How can they do that? Print money. Okay? You can't do it. General Motors can't do it. Only the government can do it. And absolutely. I mean, I can go back to my chart. You just look at how much we borrow and how much growth we have. I mean, there are years we're borrowing $1 trillion when we're having a tough time getting, 2% growth, which is 400 billion. Oh no, that borrowing creates lots of growth. It's not an investment. I'm not saying it's investment.
You're describing spending, not borrowing.
Correct. But spending, if I got it from taxes, would not create the growth. Think about it, because then I'm just taking money from one, Peter, to pay Paul. Spending, when I borrow the money and I never pay it back, I don't even make a payment on it. That's very stimulative. Do it in your own household sometime. Seriously. I mean, do it in your own, whatever you got. Let's say you make $500,000 a year, $1 million a year. Borrow $100,000 each year and see what it does to your lifestyle. It spends, it creates growth in the amount you're spending. It's not investment. You never have to pay it back, keep in mind, right? Because you can print money. Now, you can't print money, but the government can. So you're right in a way, but I think what you're telling me is you don't like it. I agree with you, I don't like it either. But it is reality. That spending is our growth. And that should scare the hell out of you, okay? That spending is our growth. We're spending $1 trillion. We have no hope, and frankly, no plan, and no interest payback. Have you ever heard anybody talk about my 60-year plan to pay back the debt? No. Nobody has any interest in paying it back, okay? And a smart economist from Harvard will tell you we don't really need to. And I will say that's true until printing money creates immediate inflation. Because as long as you can print money without creating inflation, you could borrow another 30 trillion. No problem at all, right? Right?
Bob, thank you very much for your
Yes.
comments. Paul Horn, I'm
Yes, I know, Paul.
an international economist. A couple of underlying factors, I think, contribute to making the real danger. One is that the propensity of Americans to save has diminished over the years. And as savings have diminished, both personal, corporate, and government especially, the propensity to consume has risen. We're the only developed country in the world that spends 70% of GDP on private consumption. We should be spending in the region of 60 to 65, in which case we'd have more savings, and that would help deal with the deficit. The other is that we've had a systematic reduction of taxation. We currently, in terms of total taxation, municipal, state, national, Social Security, we spend about 34% of GDP. That is down substantially from where it had been back in the, the holy 50s and 60s. The OECD average is about 41% of GDP. So the systematic reduction of taxes has meant that we don't pay as we go. In terms of the financial crisis and the rising of the balance sheet of the Fed had to do that in order to save the financial system. And in fact, they were able to bring back the balance sheet fairly significantly, as you pointed out. Then we got hit by the pandemic, which was a unique hit to the financial system again. So again, they raised the money. Last point is that the politicians have benefited from the ability of the Fed to use additional weapons, including quantitative easing, to deal with these crises, the financial crisis and the pandemic, to save the financial system. So you've got these underlying movements going on, and your point about productivity is extremely important. If productivity were growing twice what it is now, total factor productivity, not just labor productivity, we would be able to deal with the deficit when brought back into the trend rate.
Absolutely right. So, and your point on TFP, well taken. Always look at TFP productivity, not the normal stuff you get to see published. That's more of an economic issue. But what Paul's saying is really what productivity is, right? You're going to have to save, maybe consume a little less, maybe a little higher taxes, or, cut your federal spending, either way. And this is all part of why productivity is no fun, okay? Paul's kind of giving you the no fun thing, which is true. I would say, Paul, that, I didn't see a whole lot of a change in that balance sheet after 2008, 9, 10. So we might look at that chart again. Again, the Fed's under a lot of pressure to print, and I'm not saying they're bad people or anything like that, but when the government's borrowing as much as it is, they really need to print or interest rates will fly.
Caleb.
John's hand, sorry.
Thanks, John. I don't disagree with your general thesis that excessive borrowing is going to lead to inflation. That seems kind of obvious and not objectionable. Yeah. But where I'm kind of startled is by your investment advice and what to do about it in your previous books and in this one, which is basically a 200-page brochure for your firm. And no, that's fine. That's what everyone does. That's normal. I don't have any objection to that in and of itself. But the last time you were predicting an imminent collapse, you were telling people to sell all their stocks and get a fixed rate mortgage as soon as they could, to buy gold. Let's see, this was in 2008, and if investors had followed your advice, I pity them. That was terrible advice. And I see in your book you're talking about how the macro picture is intact, but the day-to-day trading system is driven by your proprietary system, which you don't divulge the details of. Well, then why publish investment advice based on the macro picture that has such a short shelf life to begin with? And you can cut me off anytime.
Yeah, I was going to say, what's your point here?
Yeah, basically, the parts of what you said tonight that were unobjectionable were pretty broad and obvious. The particulars seem almost entirely wrong every time.
Give me some particulars that seem.
Oh, okay, all right, yeah. Well, you compare, for example, Warren Buffett to the S&P, but
Correct.
You use a discrete 10-year period. What?
Yes,
Buffett has a realized...
since the financial crisis, and that's
Right,
a critical
right.
time period. Is since the financial crisis, when we've done this massive borrowing and printing, I think that's hugely important.
Right,
is
but
that
we've had a number of financial
crises. Buffett beat the S&P before, as I point out in the book. He's beaten it before handily, as has other people, like the Magellan Fund.
Right.
I'm saying since the financial crisis, that's become a lot harder, and that's a critical point to make.
Sure, but
and by the way, that's a whole chapter.
Why wouldn't you, for example, if I were putting this in my investment materials, I would want to use a rolling 10-year period?
Book only has about 2 chapters on investment. It is
but that's
very
the whole
much,
point of it.
No, absolutely
It's
not.
what do people
Oh,
do
God,
in
no.
response
No,
to
I
this?
was, no, absolutely not. No, this book is about a very, very important economic issue.
I mean,
As
literally,
said,
the
issue-
slide that's up
what-
there right now is about how people can invest with
And
you.
that's of 20 slides, how many? That's one.
It would help if the
One.
questioner would identify what is insensitive.
Yeah.
I'm,
I mean,
I'm-
you're
my
talking, the
interest-
last slide is
my-
this. Absolutely, I make money that way.
My interest
And
is
by
that
the way,
his
people have done
conclusions
very
are
well.
misleading to people, and I have a problem
How?
with people selling
How?
investment advice.
I'm-
I'm saying it. The investment advice in your book is
Well, I
buy
have a
my
problem with people
system.
selling investment advice too. I think it's what I mentioned is, you
The-
got some of the best hedge fund managers in the world who can't even beat the S&P.
The investment
You know,
advice in
go
this
to-
book is buy my secret system, but I won't tell you what's in it.
Then don't take my investment advice, my God. Screw it, okay? I don't care. I'm much more interested in what I just talked about. All of our growth has come from government borrowing.
So,
That's not true. Look at my chart. I mean, I look at how much growth you get each year. What's 2% growth?
point is that's a fundamental attribution error. There's been growth that's attributable to borrowing.
No.
There's also been economic growth
No.
that's not correlated to that.
No, that's not true. If you take that government borrowing out, you would be in a massive recession. Go out there and fire.
It's not the same as what you said, though.
It is exactly the same. No, go out and fire everybody at the Pentagon and see what would happen to our economy, certainly in D.C.
It's not the same as saying that all economic growth is attributable to that.
It is, because if I dropped that borrowing, you wouldn't have that growth.
Saying there's another force pushing on the other side of that. That's not saying
Huh?
the economic growth is a result of that. There has been some economic growth. as a
Cut
result
that
of
deficit and you'll see what the hell happens to our economy.
Yes, I hope that people who read your book don't take that investment advice.
I didn't, that's not
So,
investment advice.
so-
That's not investment advice in the slightest.
So this is
That's
a-
an analysis of our economy. And that's what most of my book is
so
about.
this is a good illustration of, this is what the Committee for the Republic is all about here. So it's an argument, I have dogs that eat 3 times a day and bite 3 times a day, and my wife do the same thing. And so I love argument, and that's why I miss Bill Nitze so much, because Bill was, you could always get in an argument with Bill, and you'd always improve your argument from having been in an argument. And so I was so proud of Caleb we had Hedrick Smith, you remember that? He had the book on the middle class, and Caleb got up and took him on, and I drove him home that night, and he had never, he'd been the top head of the Washington office of the New York Times, and Pentagon Papers, and the top of the food chain, and a wonderful guy. But he had never had anybody challenge him, and Caleb took him on, and I complimented Caleb on that. And I had to tell Rick, I said, this is good. You want to go to a salon and not be taken on. Now, we've had people walk out. I think Chaz didn't call on somebody, and they stormed off to the bathroom. But anyway, so we're good with this, and we'll continue this. So, Pat, you're next.
Yeah, thank you. I'm Pat Malloy. I'm a trade lawyer, so I'm interested in that aspect of what we're talking about. Last year, we had about $1 trillion trade deficit in manufactured goods. So that means that you're sending $1 trillion out of the country to purchase these goods, and they're not coming back to buy your goods. These dollars sometimes come back to buy our bonds, my understanding.
Correct.
So when interest rates go up, that's a whole new flow of money that's flowing out of your country to other people to buy your assets. Warren Buffett said in his great Fortune magazine article that we're like a family living on a farm that's no longer earning our way, and we sell off a piece of the farm each year to support a lifestyle we're no longer earning. So how much of the bonds that are being put out by our government each year are owned by foreign countries or governments? And what does that mean for the future standard of living of the United States and our net investment position?
So what's interesting is, our two big foreign buyers of bonds are China and Japan. And strangely enough, they actually haven't been buying that much in the last few years. They've held it each at about $1 trillion. But it has been important in earlier times in terms of supporting all this. It's just that the big guy in the big gorilla is the Fed now. The Fed's who's buying a lot of bonds. Although let me also say that if you want a good blog, WallStreet.com does a wonderful breakdown of who's buying our debt. Surprisingly, it's an awful lot of American institutions and individuals. Be shocked at how much of this debt is being bought. And not as much foreign as you might think. The percentages change a bit, and there's still a net foreign demand, even if it's not from Japan and China. But it's the Fed that's becoming much more important. They're the ones who provide that swing buyer, let's call it. If you need to buy, the Fed will come in. And just to give you an idea, I mean, think about it. Let's say China decided to sell $1 trillion worth of bonds tomorrow. In the past, that used to be that'd be devastating, the bond market. Yes. Now, again, it's not a direct connection. So the Treasury issues the bonds, and the 4 primary bond brokers will buy them, and then they go out to the market. I mean, the Fed just goes to the market. It doesn't target anybody. It just throws out bids and says, we want to buy bonds at this, and practically anybody, foreign or domestic, is able to make the bid.
What percentage of the bonds that the Treasury puts out
Mm-hmm.
are purchased by the Fed?
So again, it changes over time, and again, there's no direct purchasing. That's not a huge issue, but it's a legal issue. There's no direct purchasing allowed. But what you could say is all you do is just look each year and say how many bonds were thrown out and how much money did the Fed, buy. How much did they buy? This year, the Fed hasn't really bought much of anything. Okay, so all those bonds have to be bought by somebody other than the Fed this year. Now, previous years, the Fed would be buying, more like upwards of a third of the bonds. So it can change a lot, but in the end, again, they're the swing player. But that's one reason interest rates are going up right now is the Fed is not buying, right? I mean, otherwise you'd have interest rates still at 1.5%. So, the Fed right now is in no buy mode and actually in sell mode too, right now, as of August.
So, Bob, let me ask what I think Pat's getting to. You said we had $30 trillion worth of debt, and we had 24, and then the Fed stuck $6 trillion on their balance sheet, right? There were no domestic buyers for that. There were no foreign buyers. Chinese didn't buy it. Japanese didn't buy it. It's just sitting there on the Fed's. So are we 24 trillion in debt or 30 trillion in debt?
Well,
if nobody's bought the debt, are we really? Is that real debt?
Oh, absolutely. Because they bought. So
but
even
it's
if
different. It's
the
different
Fed,
than what we did before, right?
Yeah, no, even if let's say, and this is an interesting question because you get this concept of a reset that somehow it's just a balance sheet issue. Is that hey, if the Fed owns $9 trillion of our bonds, they just write them off, right? And then we're in great shape. Well, it doesn't really work that way because once the Fed writes off U.S. Treasury bonds, the U.S. Treasury market will explode. I mean, oh my God, you've got to be kidding. Because remember, the Fed, they're assuming these are real assets, okay, and that they can send back in. All of a sudden, they say the U.S. government bonds are not real assets. Really? Imagine what the bond market's going to think about that. Huh? That's a huge, yeah.
That's like
that's
defaulting on the debt. Right?
Yeah, it's like defaulting on the debt almost. Yeah. So, and if you ask how much is bought, well, the Fed's bought $9 trillion of bonds. We have outstanding about $30 trillion. So you can see the Fed's bought over, that period of time, most of which is in the last 20 years, the Fed's bought about a third. About a third.
Do they get the interest on
They certainly do, absolutely. I mean, the U.S. government's good for its interest because... Yes, absolutely. Yeah, I mean, the Fed is not in and of itself a money-making operation.
So let me just see.
But yes,
I'm trying to get my mind around what you're saying.
Yeah, it's an interesting and tricky.
If you said that we're going to continue, we know in the end what Yogi said is anything that can't go on forever will end, right? We know that. But you saying this could go on for a long time. Maybe it could go on 10 years. So let's imagine that it goes on. It continues to go on. And you said that until we get hyperinflation.
high inflation. Hyper for the US is like
Okay,
20%.
well, something more than just inflation, right?
Something more than 8% or 6%, but like 20% is a lot for this country. It
Okay.
may not be much for Argentina.
So when
but
we
for
get
the
a
US,
severe inflation, at that point, they will stop adding bond, is the balance sheet of the Fed going to continue to grow?
Yeah.
Is that what you're predicting?
Yeah, because when you're
So,
in.
so if we add, so if we added 6 trillion in the last, what, 2 years?
2
from the
years
pandemic?
almost, yeah.
So let's say we add another 6 trillion, so the balance sheet will go up to
30, excuse me.
13?
No, another 6.
14?
14, yeah.
14 trillion. So are you predicting that if it doesn't bust and we can kind of wiggle through this and continue more of the same, that it could go to, they could double their balance sheet?
Yeah. I mean,
And that's
yeah.
what'll happen. There won't be buyers for it, right?
Correct.
There won't be Japanese, Chinese, no European buyers,
I mean,
no
the-
domestic buyers.
The other people
Or-
will, buy some. I mean,
Some,
again, as I was saying.
but I'm
this
talking
year,
about
a lot of
net,
American-
net, they're not going to buy that amount.
No, not that amount, no.
So it just goes on the balance sheet of the
Ongoing.
Fed.
Mhm,
So
absolutely.
how does that, how does that work? All right, Warren, can you explain that? Because, okay, we
Yeah,
got two
Paul,
people.
yeah.
We'll have 2 people try to explain that.
Just a couple of factual points. One, the balance sheet has not grown for 3 months. It's actually declined just slightly.
Well, and in August, it actually took a $50 billion decline.
Yeah.
It's very significant.
So the expectation is that now that they are explicitly fighting inflation, et cetera, that it will continue to decline. The question is how fast, we don't know, but it should continue to decline. Then the historical question is, the next crisis that comes along, what do? Do they reverse and run it up? Who knows? But at the moment, it is slightly declining and expected to continue that for the foreseeable future.
I agree.
I want to clarify one other point, and I agree with what you said about the debt on the Fed's balance sheet. Data that is reported on the public debt, not the deficit, which is the borrowing flow over time. Debt is the accumulation of all of that borrowing over all time, and those stock and flows get mixed up sometimes.
They do.
But another figure that gets mixed up sometimes is net debt and gross debt. Net debt is debt held by the public, and it excludes what's on the balance sheet of the Social Security Trust Fund or the Federal Reserve or so on. But you're absolutely right that it's the gross debt that is the relevant measure of what the government owes people who lent to it. So just important to keep those things separate. And Pat, the Fed for some time now with this big balance sheet is making huge profits, and beyond a narrow amount for covering their expenses, they remit all that to the Treasury. So the Treasury loves seeing that.
And John, can I, because, in other words, I'm doing something that is contrary to the current trend. In other words, he's absolutely right. We're not growing our balance sheet this year, and it is going down. And I think that'll continue. I think the Fed is, going to keep selling it down. I think there'll come a point sometime next year, Paul and I might disagree as to when, or might disagree entirely that it will, but I think it will stop. I don't think the Fed will take more off the balance sheet, and I think it'll be forced ultimately to expand it, not necessarily because of a crisis, but just as we saw in past, even during periods of a good economy, the Fed's balance sheet actually expanded pretty significantly, even in that 2013-14 period. It really never dropped, but just briefly, I think that was like 16 or something. So, or maybe it was 19, I forgot, 18, 19. So I'm predicting a change in trend, and which may, we can all differ, may not happen. But I'm saying based on the past history, based on the pressures, I think the Fed will be under to maintain low interest rates, it will change. I don't know.
About 5 or 6 years ago, John, and it was a beautiful baseball cap, and on it was written, "Make Congress great again."
Again.
And I wear it with pride, and I often get a lot of comments. I think you're unfairly blaming the Fed for filling in the gap left by Congress, because it's Congress that cuts taxes and raises spending every time. And the Fed is left holding the bag, and it has to do what it does in order to save the financial system, as especially at ARC.
Yeah, no, and I think, Paul is absolutely right, is that, and that's what I'm saying, the Fed is under pressure to do things, to keep interest rates low, even when the Congress is borrowing fabulous amounts of money. And there's no question in 2008 that it kept us from going into financial crisis. Again, it wasn't just to bail out Morgan Stanley or rich guys. I mean, we were going to go into a financial crisis in 8 and 9 if the Fed didn't do what it did. It's just I'm saying at this point, though, we're solving all our problems by printing more money and borrowing more money. And I guess you're right, Paul. What I would say is you're better off letting the crisis happen then than later, when we've got an even bigger balance sheet and an even bigger debt. But it would be a hell of a crisis. So don't let anybody fool you that in some way, we could have just let Lehman go and that had been it or something. No, I mean, it would have been a big deal. But you're absolutely right. Congress is the issue. The Fed is more forced, and I very much would agree, is forced to do things. And that's one reason I think both liberals and conservatives in the Fed kind of do the same thing. They're forced to.
We got a question here. I wanted to just make one comment. Paul, clearly these guys are not doing their job, right? So the founders gave the Congress, made them number one, Article 1, right? Gave them 18 enumerated powers, more power than any legislature in the history of the world has had. And we had the greatest legislature in the world in the 19th century, right? With Henry Clay and John Quincy Adams and Daniel Webster and John Calhoun were the deciders. So why, with the war power, right, Congress is, in my lifetime, we haven't had a constitutional war. I mean, Korean War, I was 2 years old. All these, our whole foreign policies operated outside the Constitution in my lifetime. And in the war power, the money power is the same way. Basically given this responsibility for the money supply over to the Fed, right? The Fed, right? So the abdication of Congress, right? Now this just didn't happen, right? I mean, this is Hollywood, right? These people are not doing their job, right? In Hollywood, they're actors. These people are actors. And who are they? Why are they doing that? They're doing that because people vote for them, right? Because we're the sovereign, we're the people, we have the sovereignty, right? So you look and say, where are the fingerprints at the crime scene? And I submit it's the Democratic and Republican Party that are perpetuating a warfare state and this fiscal irresponsibility. So anyway, that's my view. It may be a minority view. I was at a lunch out in Rappahannock County with 15 individuals, and I said, am I the only one that thinks this Ukraine is crazy, what we're doing? And everybody looked at each other and then looked at me, and they said, yes, you are. So I don't have to be the only person.
To what extent do you think the standard of living in this country will be higher or lower 20 years from now? And to what extent do you think that government fiscal and financial policy plays into that? And how do you define standard of living?
Standard of living I define as pretty much how everybody else would, in a sense, is kind of how much money you're making, I guess. But obviously it depends on whether or not, how long we can keep pushing up this balance sheet and the debt. And as soon as we can't keep pushing it up any longer, that's when it blows. Will that be within 20 years? Probably. I would guess it will be, almost certainly. But I don't know for sure. As I said, actually, way back in the Aftershock books, if anything we're going to be wrong on, it's going to be on the timing. Timing tends to take longer rather than shorter because a lot of psychology is involved and that kind of thing. So yeah, I mean that's the that's the bottom line is that I think we'll be paying for this for a long time. And the big problem you're going to have in 20 years is not just that you've got a crushed financial system, crushed government financial system. That's terribly important. But we haven't been spending much time worrying about productivity. We've been spending a whole lot more time worrying about keeping up asset prices, which, believe me, works really well to make money. I mean, nobody makes money as fast as Elon Musk. I mean, Henry Ford's not going to make it, Andrew Carnegie's not going to make it, John D. Rockefeller's not going to make it that fast. So this is really incredible. We focused on how to, make companies that, have $500,000 in losses or, more being worth $2 trillion or $2 billion. So we focus way too much on asset prices and not enough on productivity. And that includes things like savings rates, consumption, all these kinds of things that we just haven't focused on much in the last 20 years. Or properly using computers, again, education, government, hospitals, healthcare, all massive use of computers, but I'm not sure we're seeing the productivity growth out of them. And there's been some economic studies on that as well. I think it was James Tobin did some on, why don't we see productivity from the PC? And we really haven't. But later on we will, and don't worry, go 100 years down the line, and you'll find at that point we're made a lot of changes to improve productivity.
One quick follow-up. If you do think that in 20 years everything will fall apart, what steps
Well,
should be
wait.
taken? Not everything.
Yeah, let's be clear that economy, asset prices can go down 90%, okay? I mean, really can at this point. Economies can't. I mean, if an economy falls 30%, that's huge, okay? Our economy's not, we're not going to be like the 20s at all. Very wealthy economy. Nobody's going to have to worry about eating or stuff like that. Anyway.
If you're faced with a trade-off today, is it clear to you that the best option within the next 5 years is to start unwinding this?
Absolutely, no question. I think we should have unwound it in 2008. The best time to have unwound it was when we started back in 1981, 82, 83, running those deficits, right? We should have unwound it then. But if you do that, you're going to get a recession. Just like right now, you're going to get a recession if you unwind the deficit. I mean, again, whether it's all our growth attributable or not, we all know that you cut that deficit of $1 trillion this year to zero, we're in trouble, okay, economically. But that's what we should do. Is anybody going to do that? Of course not. That's part of what we're saying. What we're going to do, one way or another, I agree with Paul, the next crisis we have, like 2008, we're going to bail everybody out, okay? We shouldn't, but there's no way around that's politically not feasible. I mean, people just aren't going to support it. I mean, even the politicians who've talked about cutting deficits and stuff, there's no resonance among the voters. So I don't want to blame entirely Congress or the Fed. I mean, the voters are not very supportive either. So, yes. I guess. You'll come right next, all right? Promise. Yes.
Skip Kaltenhauser. I have the assumption that the New York Fed is a subsidiary of Wall Street. Is that true? And what additional hazards does that pose if that's the case?
Well, I think there's no question one time that was true. I mean, the Fed was created as a government and private entity, right? And the banks did have a lot of influence on it. I would say, though, that going forward, I think more of the influence on the New York Fed, and again, having personally known the guy who runs the open market operations desk there, is really coming more from policy. In other words, the open market operations desk at the New York Fed will respond to what the policy recommendations are. If they want a 2% interest rate, the New York guys will do it. So I think we're getting away from maybe what it was, and certainly in 1920 or so, where it really was just private banks kind of telling the Fed what to do, to more it's really policy. And shoot me, but I do think that the Fed is going to focus very much on trying to prevent a financial crisis, not just saving Morgan Stanley. And that's what's going to happen. It's a little different than it was 60 years ago, where I think a little more of a cabal. I think they're going to focus on policy as set by the Federal Reserve Board.
Thank you, Robert. I understand that we are able to run these massive deficits in part because there are no guardrails on the banks after the denouement of Glass-Steagall, and because we have control of the world's reserve currency. And so we really have unlimited financial resources from which to continue borrowing. But when is this going to end? And you've got the Russians and the Chinese and the Indians who are all of a mind that they want to replace the dollar as the world currency. And that will severely crimp the Fed's and the bank's ability to borrow. So when is the music going to stop? And why won't we have a Weimar type situation?
Great question, yeah. In this case, we have a very different government that I don't think will want or allow, and a Fed that won't allow inflation to go anywhere near hyperinflation levels. Again, but 20% for this economy is huge, okay? We're not Turkey or Argentina, and I'm not saying it won't go beyond 20. But the other issues are just frankly not as important as our ability to print money without creating inflation. And everybody kind of, when you think about it, that would be really cool. No, not true. I mean, in reality, Europe's doing a lot of that. I mean, Japan's doing a lot of it. China's doing a lot of it. So, that's what's fascinating. This is a broader issue than just the U.S. And the U.S. being reserve currency, I mean, I think we're now, what Paul, I sent you figures or something, it was like 20, I think we're, I don't know, but we're like 59%, euros 29% or something. I mean, it's not that important. I mean, if it switched and the euro is 40% and we're 30, it doesn't matter. The power comes from printing without getting inflation. And we're the top on the ladder. We're able to do that because we have tremendous, financial credibility. It's like we have a great, credit statement, whereas, every other country's gone through a financial crisis. Japan, Germany, as you said, Weimar Republic, France, Britain have all had huge problems. We haven't. We've really earned our place at being the best financially stable country. I think we're losing that fast, but that's why we've got it, is we can print without creating inflation. Screw the dollar and position and all that. It's really not as important as that one fact. And that's why it's more vulnerable, and I think that's why people don't focus on it, is that, man, you lose that ability to print without creating immediate inflation, you're screwed.
You accurately predicted the 2008 crash. I'm wondering if you could compare the factors that led you to predict that crash with whether you can predict the popping of the current bubble.
I think that's almost a what have you learned since then question, right? Well, one thing I've learned that I was shocked by, that made a lot of my predictions in a sense wrong, but they weren't quite as what he's saying. But I might add that what it really was is I thought we'd get inflation earlier, okay? I mean, I thought when you double or triple your money supply, you get inflation, okay? I was wrong. And honestly, I'm not the only one. I mean, if you look at the dogma of economic profession in the 90s, it would say inflation will come when you print money. If you look at Milton Friedman, inflation is always never a monetary phenomenon. You should have gotten it. And we're not getting anywhere near enough interest by the economic profession figuring out why we didn't get it earlier, right? And so because we don't really understand it, I'm going to put the same caveat on my future projections. I don't know when we're really going to get this serious immediate inflation. I don't know. We obviously are getting part of it now, which is telling me that, we're getting there, but clearly part of it today is supply and demand prices. So if I was to change anything from earlier predictions, it's that this inflation could take a long time to get going because there's a lot of psychology. And this is a call to the economics profession. We need to figure it out better. I mean, I think Milton Friedman is correct, is that when you print money, you're going to get inflation. But obviously, there's something more going on. We printed a lot of money, and we didn't get much inflation. So Milton, time to, get out of your hibernation here in the grave and pop back up on Earth and let's figure out what's going on here because it's clearly more than just a simple monetary print money, you get inflation. There's a lot of psychology involved. And so that's what gives me hesitation on future projections. What I will say is I think that I'm pretty comfortable with is that the Fed will save us if we have a big problem until it can't. So, that could be I think that'll be a ways off.
Bob, can you clarify your views on the Fed? So, as I understand it, when the Fed was started, in 1913, the dollar was worth so much, and today it's worth how much? $1913, is it? Worth 1%?
It's like 3%.
And one of their job was to control inflation, right? So, by any standard, they failed.
Well, The one thing, and Paul was pointing this out, the one thing they really were created for was the feeling that J.P. Morgan's not going to be able to bail us out of the next banking
lender
crisis.
of last resort, right.
And Morgan
Right.
could do it because our economy
Right.
is relatively small, early 1900s, 1903.
Right.
But everybody's sort of realizing that's probably the last time JP is going to be able to solve our financial crisis. The private guy can do
Right.
it. We were becoming a really big economy, and we needed something other
And
than
the
JP
guy
Morgan.
that didn't get the golden ring and didn't get the head of the federal, the Princeton professor that wrote a book on the Fed.
Oh, Alan Blinder.
Yeah, he talked at the.
No, Alan Blinder from Princeton. Yeah,
Yeah,
he's
it's
a
a
good guy.
wonderful book, and I read the thing. It was utterly soporific. I guaranteed I didn't, it put me to sleep. But he listed over 400
economics
things the Fed does.
Yeah.
And I don't think anybody at the Fed knows all the things they do. But the other one, then they were given employment later, right? And so the employment, right, that was thrown in some statute in the 50s.
Right, that
or
was thrown
something.
in.
Congress gave their job away on that.
I mean, but let's face it, preventing a financial crisis could be related to employment too. I mean, if you have a financial crisis, people are going to be tossed out of work. So a lot of stuff is very, very similar. And I think still the primary goal is to prevent a financial crisis, which is why.
Right.
I think
So
we'll
we
come
had
and bail out
Ed
the
Kitch
stock
and
market.
Julie Mahoney from to teach law at UVA on his salon, and I hope you guys, if you didn't come, go look at it on. But they essentially said that the real job of the Fed is not inflation, is not employment, is not even lender of last resort. What the Fed is really doing today is holding up the real estate market and the Treasury bond market. That's what their
Completely
new job
agree.
is.
But
huh?
doesn't that
But
sound
nobody-
like you're preventing financial crisis by doing that?
This is another way of saying it, right?
But you see, this is why it gets so tricky, because in a sense, that's what they are doing. That's good. We all like that. It's just that if it's only temporary, then that's bad. In other words, if you win the battle, but the war is going to be lost, and all it means is you're just putting more and more troops and more supplies and more and more money into it, and instead of killing 20,000, you kill 50,000 or 80,000. That's when it doesn't work. What we're hoping is by the Fed, putting in the 20,000 troops now, call it the surge, for lack of a better term, that we're going to win the war. And what I'm saying is I think it's a little more like Afghanistan. You can put in the surge and you're not going to win the war.
Right, that's a good analogy. I like that. So you agree then with them. So they were positing bankruptcy, and essentially we had bankruptcy in the beginning of the country when we borrowed. We ran an $80 million war against for 7-8 years against England, and we borrowed from the French and the Dutch, and we basically Hamilton came in and he restructured the debt. And they were proposing that we do the same now. But I don't think that's what's going to happen,
not gonna be restructuring.
right? It's
You
not
just-
going to. It's not
no.
going to be. That's not part of your reform.
No,
right?
what you have now is a massive inflation. Again, we couldn't have done this in the past because we didn't have the credibility to print a lot of money and not get inflation. So we're basically burning up our credibility. If you think about it, we're more like a very wealthy family, that has a good credit rating. We have good incomes. We can really go out on a limb in terms of how much we can, borrow in a sense. And when we go back, again, we're not like falling apart or anything. It's just that, asset prices can go down a lot. Your economy can't. And we're still, look, if we're a $20 trillion economy right now, even if you went to half, cut that in half, it's $10 trillion. It's a lot of money. And I do think the U.S. will still maintain a position of being the largest, fastest growing economy going forward, or the biggest economy. It's not going to be China. China's going to get hit even harder than the U.S. going forward. Yeah, because China's sinned. If we have sinned in what we're doing, China's sinned even more in the amount of money it's printing and borrowing as well.
What are the numbers, China?
That's one of the toughest things. I have a friend over at the Institute for International Economics, and I always asked him how much money is China really printing, and I don't know, because when China prints, they print through their banks. They tell their banks to lend out money and so forth. So, it's a bit of a different system, but
It's not transparent.
It's not that transparent. So I can't really give you numbers, and so you say, well, then I write off what you say. And
But
you may
you
be
s-
right, but I think in general people would agree, international economists, that China is doing a certain amount of printing and borrowing, certainly borrowing.
Did you want to? Oh, yeah.
How does government debt compare in size to private debt?
It's a great question. So, 30 trillion in government debt. I think mortgage debt is somewhere like around 12 trillion or something like that. I don't know about commercial real estate, but mortgage would be your biggest. Commercial real estate, I assume, would be at least somewhere in that range. If you put all types of commercial real estate together. Let's see, I guess we know student loan debt is bigger than credit card debt, so a couple trillion. Yeah, student loan debt is bigger than all credit card debt combined. Yeah. It's grown fabulously in the last 8-9 years. So, yeah, I mean, really fabulously. It's not bigger than car loans. I'm pretty sure car loans are still bigger than credit card or student loan, like 3 or 4 trillion. But there's a huge difference. All of those debts have debt payment plans, right? I mean, and they are being repaid. Mortgages are being repaid, Car loans are being repaid. Student loans is a different issue, but credit cards, et cetera. Whereas the government debt isn't. There's no plan, no interest, there is no repayment plan. To make our payments on the debt, we just borrow more. To make interest payments on our debt, we can borrow more. I mean, if you take that plan into a bank, they'll just laugh. Exactly. They'll laugh at you. So private debt is very different. The problem you have with private debt is if interest rates fly, if the Fed lets interest rates fly because the government's borrowing so much, well, then private debt all of a sudden becomes very hard to get. And that is a problem because all of a sudden it's harder to buy cars. It's harder to, buy credit card stuff. It's harder to buy houses. And we're running into that right now is at 6% mortgage rates, it's harder to buy a house now, a lot. And so it's in a very different category. It's very affected by government debt, but it's in a different category because they are really, we do have a payment plan on private debt.
So, great discussion. Assuming we're not going to be able to reduce military spending or increase taxes, at least not in the foreseeable future, how do you increase productivity?
Poof. Oh my God. I've got 25 books on that coming out. So ping me in about a year and I'll actually have a whole series of books on how you improve productivity in each area. And each area is different. Education, healthcare, entertainment, transportation, utilities, energy. All of them are different. But all of them, require significant changes in how we're currently doing things. That might also be like for corporations. More outsourcing. I know it sounds awful, but yeah, right. But yeah, corporations have already improved their productivity by outsourcing. Now, some people would say it's just union busting, which is partly true, but it's also, corporations like GM can say, I'm going to, auction this off, this contract for this part to the lowest bidder. So there's a lot of ways, but it's different with every single area, and that might include property rights like, police, military, and so forth. So. It really is a whole different discussion, and it's a wonderful discussion. And seriously, come back in about a year. We're about 5 books into 25, but by the end of next year, we'll have all 25 done. It's a really good question. So there's really the three biggest impact will be transportation, energy, and information, and ultimately also housing. Interestingly, housing. Because you'll find that's where a lot of our money goes in the future is much better housing than we have today. And productivity of building a house, radically different. And part of that productivity is very scary. It means having low land costs. Ooh. How do we get low land costs? Or do we even want low land costs? I don't, nobody around here wants it. So some of the things that create better productivity, which is not passed today, which is the silver lining of an aftershock is all of a sudden you have much lower land costs and nobody really wants to raise them at that point. And so you have higher productivity, much higher productivity from that alone. Also, I might add, if you reduce your military spending and you don't get invaded or attacked, you've increased productivity, right? But it's difficult. Productivity and growth is just tough. I mean, think about it. You can invent a car, but then where are you going to get the roads for it? Where are you going to get the service stations? It's hard. I mean, what people did to build this country was tough. And not just this country, all countries. But it's a very tricky thing. But please come back to me in a year. We'll have books on each and every area.
We'll have a productivity
salon.
salon. Okay. Give me your ideas on that. But thank you, Bob, so much.